In this final lesson of the week, we're going to tackle uncertainty in lease transactions. Every lease we've recorded so far has had a tidy ending. The payment stopped and the story was over. Real leases are messier than that. The asset comes back with value left in it, and the lessee might have an option to buy it. This lecture is mostly conceptual. I want you to understand who bears these risks and how they change the math. One thing that won't change, though, is the journal entries themselves. We will still debit and credit the same accounts. Only the amounts will be affected. One question that nobody thinks about until it costs them money is what happens when a leased asset comes back at the end of the lease. What is it worth? If you're the lessor, you care deeply. That leftover value is part of how you get paid. You're expecting an asset that has value at the end of the lease. And if you're the lessee, you might have promised it would be worth a certain amount. We call that leftover value the residual value, and it quietly changes almost every number in the lease. The residual value is simply the asset's expected value at the end of the lease term. The question that matters for accounting is, who bears the risk that it disappoints? Sometimes the lessee guarantees the residual, promises the lessor the asset will be worth, say, $7,000, and agrees to pay any shortfall. That's a guaranteed residual value. Sometimes there's no such promise, and the lessor simply holds the hope that the asset has value at the end. That's an unguaranteed residual value. Same asset, same expected number, very different risk, and the accounting follows that risk. First, watch what the residual does to the lessor's pricing. Remember, in order for the lease transaction to be worthwhile to the lessor, they need to be able to recover the asset's fair value, its selling price, plus some interest, since they won't be getting paid the full amount today. But if the asset will come back with value at the end, the lessor doesn't need to charge the same amount to cover their required return. So the lessor's arithmetic goes like this. Start with fair value, subtract the present value of the residual. It needs to be present value because it will be a few years before they get the asset back. And then calculate the payments to cover the remaining amount with interest. A bigger residual means smaller payments. That's exactly why leasing a car costs less per month than financing the purchase of the same car. The lender is counting on getting the car back. Now the lessee's side, and this is the distinction that is an often tested concept. An unguaranteed residual is the lessor's business, not the lessee's. It never enters the lessee's liability. A guaranteed residual is a promise the lessee made, but under current GAAP, the lessee includes in the lease liability only the amount it expects to actually pay under the guarantee. If we expect the asset to be worth the guaranteed amount, we expect to pay nothing, and the guarantee adds nothing to the liability. If we expect a shortfall, the expected shortfall gets present valued into the liability. Expectation, not the full guarantee. That's the rule. In the classroom, we'll usually treat the guaranteed liability as something that the lessee expects to pay at the end of the lease. The other big source of uncertainty are purchase options. The test is whether the lessee is reasonably certain to exercise the option, and nothing makes that more certain than a bargain. An option price below what the asset will be worth at the end. Even if it's just by $1, we consider that a bargain. So if there is a purchase option and exercise is reasonably certain, because it also happens to be a bargain, then it meets the definition of a liability for the lessee. They expect to pay it at the end of the lease. The exercise price joins the lease payments, and we take the present value right along with the rent payments. Remember, too, from our classification lesson, a purchase option that we're reasonably certain to exercise makes the whole lease a finance lease all by itself. An option like that isn't a maybe, it's a purchase with extra steps. Let's see the pricing effect in action. Here we have an $80,000 asset, a 5-year lease, 10% rate, payments at the beginning of each period. First, we'll set the payment with no residual. Then we'll add a $7,000 residual and watch the lessor's required payment drop because the lessor now only needs the payments to recover $80,000 minus the residual. Before we get started, I want you to notice something about this problem, and that is that they have not given us a payment. They've given us the lease term here of 5 years. They've given us the fair value of the asset, a residual value, and then a 10% implicit rate. So what we need to do then is calculate what the payment would be for the lessor to recover the value of the asset. And this is a piece of information that's been given to you in most problems and will be given to you in a lot of problems. But if you are not given the payment, you need to know how to calculate it. I would always approach it with this systematic approach. So the lessor is going to start with the fair value of the asset because they're trying to figure out what do I actually need to recover. And then they're going to subtract the present value of a residual. But in this assumption, this first example, we're going to assume that there is no residual. So we're going to ignore this residual value of $7,000. So we're not going to subtract anything here. We're going to put a 0. So the total amount that they need to recover is $80,000, the fair value of the asset. Now, instead of using our present value calculation, we're going to use our payment calculation. So PMT is our payment calculation. We'll use the rate of 10%, the number of periods of 5, and we use the $80,000 as the present value. And we don't have a future value because we're not expecting anything at the end. And then we put a 1 for the type of the lease. So we get a calculation of $19,185 as the payment. And then I'm also going to show you what the lessee then does with that, because that's what we've been used to. We've been given the payment. Once we've been given the payment, the lessee takes the payment and they calculate the present value of their minimum lease payments using the present value calculation. So the rate is 10%, the number of periods is 5, and the payment is $19,185. There is no future value of any sort, and we'll put a 1 for the type. So then they would add the present value of a guaranteed residual value only. They do not have that in this case, so the present value of their minimum lease payments is $80,000. So both the lessor and the lessee have calculated the same number to be recorded as the lease receivable and the lease liability. In this next example, let's calculate the payment assuming that there is an unguaranteed residual. Remember, an unguaranteed residual is something that the lessor expects to get back at the end. They expect to get their asset back at the end, and it will have a $7,000 value, but they're not expecting the lessee to come to the table with cash if the asset happens to not be worth $7,000 at the end. So they're going to start, like usual, with the $80,000 fair value of the asset, but they're going to subtract the present value of that residual value. They don't need to recover it through the payments because they're expecting to get the asset back at the end. So I'll do my present value calculation here with my 10% rate, the number of periods of 5. I don't have a payment here. Instead, I have the future value of the residual, and then I have the type 1. So I've grabbed the residual there. So the present value of getting a $7,000 asset 5 years from today is $4,346. So they do not need to recover that amount. They only need to recover $75,654 through the payments. Now they need to calculate the payment that they need to charge the lessee. So we'll do our payment formula, and we'll grab the rate, the number of periods. The present value is $75,654. We don't have a future value, and the type is 1. So $18,143 is their payment that they're going to be charging the lessee. So the lessee is going to do the same thing as they did in the past. They'll take that payment and they'll figure out, what do I need to record my lease liability at? So they'll figure out what is the present value of those lease payments at a 10% rate with the number of periods of 5, payment being $18,143. We don't have a future value and the type is 1. So the present value of their rent payments is $75,654. Here, the lessee would add the present value of any guaranteed residual value because they would consider that to meet the definition of a liability. They must pay it at the end if they don't return an asset worth that. They don't have that in this case. This is an unguaranteed residual value. So the present value of their minimum lease payments is $75,654. Notice in this case that the lessor's lease receivable is going to be recorded at $80,000. But the lessee is only going to record a lease liability of $75,654. This tends to make accounting students uncomfortable because of the asymmetry, but it's completely fine. This is just a record-keeping exercise. The cash is going to change hands just as they have contractually agreed to, but the way they allocate the entries on their books will just differ a bit. They need 2 different amortization tables. So if you were given this problem and you were asked to make the journal entries for the lessor and the lessee, you would need to use a separate amortization table for each of them in order to allocate that payment of $18,143 to interest and to principal. It would be different between the 2 parties. All right, let's look at this last scenario where the residual value, we're assuming it's guaranteed. So the lessor is going to start with the $80,000 fair value of the asset. They're still going to subtract the present value of that residual. They're always going to subtract the present value of any residual, whether it's guaranteed or unguaranteed. They're going to leave payment blank here and put the future value of $7,000 as the residual and put the type as 1. So they're going to subtract the $43.46 just like they did in the last scenario. And then they're going to calculate their payment that they need to charge the lessee the same exact way. The number of periods is 5. The present value is $75,654. We have no future value and the type is still 1. $18,143 is the payment. Now let's look at what happens to the lessee's calculation. They're going to take the rental payment of $18,143 and they're going to figure out the present value of that. And this is a critical step. Make sure that you get this right. You would always calculate the present value of these rent payments before adding the value of any residual that they might be on the hook for. So I'm going to use the 10% rate, number of periods of 5, and the payment of $18,143, no future value, and the type is 1. Now they need to add the present value of the guaranteed residual value because they do assume that they're going to have to pay it if they don't return the asset in a $7,000 condition. So we're going to add the present value of the guaranteed residual value. So the present value here, I'm going to make it negative because I want it to show up as a positive number. And I'm going to take the rate, the number of periods, and the payment will be blank, and the future value will be $7,000, and the type will be 1. So 4346 is what they will have to include in their liability, and their lease liability will be $80,000 in this case. To wrap up, the residual value is the asset's expected worth when it comes back at the end of the lease, regardless of whether it's guaranteed or unguaranteed. The lessor subtracts its present value in setting the payments. Bigger residual, smaller payments. The lessee, on the other hand, only cares about a guaranteed residual. If they've guaranteed that they'll cough up the cash if the asset isn't worth a certain amount at the end of the lease, then they need to include that promise in the calculation of their liability. The lessee will treat a purchase option that's reasonably certain to be exercised, a bargain being the classic case, the same way as a guaranteed residual, including it in their liability calculation.